biggest mistake that I see GPs make is they say too much and they don't listen. If a GP meets with a new investor or even an existing investor and they're raising capital and they have talked through the whole meeting, it's a missed opportunity and it's a problem.
Meghan, it's great to see you.
Thanks so much for having me, Ted.
I would love you to take me through your journey that's landed you ultimately at Altimeter.
Happy to. So I started my career at Goldman Sachs, spent 10 years at Goldman. Very lucky to start my career in private equity and alternative investments at the time that asset class was just beginning exponential growth. Spent a decade there, always focused on the investor side of the business, product management, fundraising, campaign management, investor relations, jack of all trades. After 10 years, I was recruited to join TPG. Very lucky to spend the next decade there as alternative investments expanded, grew, and we had the advent of big multi-product platforms and mega firms, of which TPG was one of them. So I spent 10 years, joined the firm when it was $40 billion in assets. At its peak, when I left, it was about 125. That's $240 billion today. And in 2021, I joined Brad Gerstner at Altimeter, which is a technology-focused investment firm for people that don't know, to help Brad really change the face of his investor relations, capital formation, not because we're trying to scale the firm to the nth degree, but because we want to have the best set of client relationships that are available to us, be the best partner to folks in what I think is one of the most interesting places to be in the world right now, which is technology.
I'd love to dive in a little bit on kind of each of those three platforms and how you've thought about the role. So you're starting at Goldman, big investment bank, big operation. What did you see in terms of that capital formation role in that seat?
So I was very lucky in that it's a huge organization, but I was part of a very entrepreneurial group. So we were building from the ground up. We were building marketing materials from scratch. We were creating reporting and a fundraising function for an asset class that was new to most institutional investors and high net worth investors in the world. The exposure to private equity and venture capital for most institutional investors when I started there was probably less than 1% on average. And by the time I left, it was probably 5 or 10. So you can imagine the growth and the transformation that was happening. But I was doing it in part as part of a larger organization that had a very established sales function. We had distribution coverage all over the world. There was deep, deep investor knowledge. The reach was very broad. It was organized by channel, meaning type of investors, endowment and foundations, consultants, pensions. And I learned about the nuances between all of those different types of investors from those salespeople. And they knew how to run a campaign very distinctly. Like it is a machine, and you learned from being a part of a very well-oiled machine.
So take that. I don't want to say you were a cog in the wheel, but that was a big, strong wheel and that you were implementing. And then you go over to TPG, where back then it was private equity. How did you think about coming into that role to run this group now that, you have to be the whole wheel?
I used to say it was like going from being a member of the crew on the Titanic, right? You were just one piece, like I'm loading the coal and that thing is running, and to going and being on like a speedboat. Though the firm was $40 billion in assets, which is large, it was a very small operation in terms of the people that were managing our client relationships, people that were doing any sort of interacting with the capital sources for the firm, people that were running communications, managing any sort of transparency. I was hire number 5 or 6 on that team. And, for many years, it was 3 or 4 people. So you can imagine what needed to be built at a time that the firm was trying to move from private equity into credit, into real estate, into growth, into all of the asset classes that are represented by that firm today. So we had to very quickly apply some form and function and structure and hire in order to accomplish what we needed to accomplish. And it was learnings from Goldman that we were able to apply. And there were a few of us that had come from that big Goldman Sachs infrastructure and other banks that was certainly not by mistake. It was by design, because they needed to create a shadow organization that looked a little bit like those processes, that had the capabilities to establish those processes inside the organization.
So when you show up, you're drinking out of a fire hose, right? Somehow, even though there weren't people in the role, there was $40 billion in assets, probably hundreds of LPs, questions coming in. And then you have to go try to build the infrastructure to help the firm grow as it did. You mentioned sort of some of the components, but what was it when you went from when you started to 10 years later when you left that created the base of what that infrastructure became?
Ted, just to overlay what the fire hose that we were drinking from, I wanted to say most of our clients hated us at that moment because it was 2010. Just on the back of the financial crisis, TPG had raised a $20 billion fund that it started to deploy very quickly into mega buyout deals right before Lehman fell and the financial crisis began. The first deal in that fund was Washington Mutual, which went to zero before the capital was called. So that is the framework for what I had no idea. I really respected the firm. Goldman was an investor. I knew people there. All of the talent from Goldman was going to places like TPG. So I thought this was the best job that I could possibly have, and to do something and build something from scratch. But it was a somewhat of a hostile environment when I stepped in. What we needed to build was basically 3 things that I think now define what is the role of capital formation. We had to establish strong investor relations. That's just the administrative layer of how does a client efficiently interact with an organization to get its annual reporting, to attend an investor meeting, to update its address when it needs its capital calls sent to someone new. I mean, there is this whole component of basic administration that at that point was built on very limited infrastructure. There's what I would call product management, which is the strategy around how you source capital for a given strategy. What is the right capital base for the investment strategy that I want to pursue? Who are the right investors for that strategy? What is the campaign around that? And as the capital gets invested, is the strategy reflecting what your investors expect? There is an involvement from people in my role that around the course of how a fund gets invested, that where you constantly need to weave that in to the investment strategy, and you need to communicate that in some way back to your investors. The third piece of it is what I would call relationship management, distribution, sales. How do you raise new capital? How do you build new relationships? How do you maintain relationships with investors that brings you new capital, expanding relationships and building new ones, and putting some organization around that?
Before you're able to jump into all of that, you can't quite gloss over jumping into a firm that you think is going to be great, that's getting crushed by the markets. What happened in that period of time as you're trying to build out some of this infrastructure where your clients don't like you, you can't imagine what fundraising is going to be like, and the relationships may have soured a bit because of just performance in the short term?
You learn so much in those moments. I tell all of junior people that I work with or people that I mentor, if shit goes wrong in an organization, start listening and just hang on tight and write everything down, because I look back at that moment in time and so much of what I've learned about how to communicate well, how to respond to investors' needs, and how to be resilient as an organization came from that time. We had to do what we called at the time a contrition tour, which was essentially David Bonderman and Jim Coulter traveling all around the world, apologizing to our investors. We gave people an option to take their money out. We gave people an option to reduce their commitment if they wanted it. About half of the people took that up. I mean, it was a $20 billion fund, so we still had a lot to work with. But those were the types of motions that we had to undertake in order to start to turn around relationships. It was humbling for a lot of people around the organization, but I think it made the organization so much stronger at the end of the day. And I think when we look forward 10 years, we had very high NPS scores from the clients that we did retain and the client relationships that we built over time that came from the increased transparency, the increased humility, the personal connections that you needed to make during that time to build from the bottom.
How much of the success of that effort do you feel just could have come from the bounce back that started in 2009?
Not as much as you would think. Honestly, I pause there because I need to reflect on how to quantify it. But I don't think that performance is sufficient. First of all, we're in private market, so it takes a very long time to bounce back. And we didn't have the time because the opportunity set in some of these other asset classes that we wanted to expand into was so immediate and tactical. The credit opportunity was in 2009 to build. The talent acquisition strategy that was happening by the firm because of the displacement of so many talented investors from other banks and other institutions that had faltered, that was the now. And so we didn't have the opportunity to wait for a performance bounce back. All of it came from great communication and great relationship building when I think back about that.
Yeah. As you do think back, was there an example of maybe a meeting that you had some trepidation going in, and because of the nature of that humility and that transparency, you felt a real shift in someone who might not have been happy with you going in and then was excited about where the direction the firm was headed coming out?
I can recall a number of meetings, particularly with state pension plans. So I recall a very specific meeting with a California state pension plan, one of the big ones. But you can imagine the boardroom with 30 people. I'm with Jim Coulter. I'm with some of the other investors from the TPG Capital team. I'm with the relationship manager. And I was very lucky to be in the room just as representing product and product strategy and prepared to go through details to the extent that we went there. But the first 25 minutes of the meeting were just venting. I mean, this is an hour-long meeting. It might have been even 35 or 40 minutes. And here you have a very high-powered group of people in the room, including Jim Coulter, who, is an incredible leader in investment management and has many things to bring to the table in a discussion around private equity and TPG. But Jim just sat and listened with great humility. And that is the biggest lesson that I took away from that moment is you can't move forward until you really understand and where someone is coming from, and letting them voice their concerns and their frustration is so critical.
As you went to help build TPG from the $40 billion when you got there to triple that size when you left, what did you see that worked in the addition of adjacent investment strategies in terms of the ability to go out and tell the story?
I think what works best, and what I would still say to people as they're building new businesses, is you cannot just fundraise for the sake of fundraising. It has to come from a very tangible opportunity set that is immediate and actionable. And what I mean by that, it is not enough to say, we took this team from Goldman Sachs who ran the special situations group there, and aren't they very talented? And we're going to build what we built there now here at TPG under the banner of TPG Special Situations, which is now called Sixth Street. It was coming to people with a specific list of opportunities and a specific number, like places that you were going to hunt, a specific hunting ground to say, you don't want to miss this opportunity. This is a market opportunity that's tangible today, bottoms up based on everything what we're seeing. This is the amount of capital that we need to go after it. And this is why it has a place in your portfolio, even though no one really understood private credit. People understand deals. They understand actionable opportunities. It's not enough to be hand wavy and say we deserve to be in a market because we've got a great group of people.
What were some of the maybe experiments or strategies that TPG tried to pursue that didn't get the kind of legs that a Sixth Street did in your time there?
We had very few failures, which is good. Look, I think we tried to scale biotech under a banner of like an organization that we had different iterations of biotech. And if you look back to 2010 to 2020, there was a biotech winter happening in the asset class. It made it very difficult to scale. And once you have difficult scaling, then you have some team dysfunction, people get frustrated, and there is a snowball that starts once you have trouble getting real traction. My reflection there is not because we made any foot faults on our marketing. My reflection there is because there was a winter going on in the asset class, and the macro matters a lot. Are the macro tailwinds behind what you're trying to raise? That's the key question. I look at the last few years and make a comparison. People that wanted to raise growth, it doesn't matter how great your growth tracker was, very few people able to raise growth in late 2022 and 2023. Like the tailwinds just aren't in your favor. It doesn't matter how good you are.
So you have this great run, great success at TPG. What led you to leave and join Brad in now what's effectively a single sector, maybe you could say single strategy firm?
When I left TPG, I was co-leading the fundraising group there, which was a team of about 40 or 50 people with a partner of mine that I had worked with from the time that I was an intern at Goldman. It was a dream role for me, and it was fantastic. But I realized that I craved an entrepreneurial role. Again, I craved a building and growing versus a scaling to the moon. And TPG was on the precipice of going public. You could see where that was heading. And when I really did the soul searching that we all did during COVID, I came out on the other side of it. And so I took some time to reflect on that, helped some friends in the venture community that were thinking about their fund. And I was thinking about what I was going to do next when I was approached by Brad. Altimeter seemed like a really unique fit for me, particularly because I had these curiosities around what was happening in venture as an asset class, the maturation of, let's call it a strategy, call it an asset class, call it what you want. But there were clearly things happening in venture in 2020 and 21 that I saw as so similar to what happened in buyout in 05, 06, 07, and the years that followed. And I had a thesis around that, what was going to happen to LPs, what was going to happen to venture firms. And Brad and I shared some great conversations around that. And so that, with the combination of being able to work in technology, which is on the advent of AI, really created the best role that I could think of. Altimeter, to level set, is 30 people. very different than the several thousand and the tens of thousands that we had at Goldman.
I'd love you to describe what you saw in that thesis for what venture was becoming that you had seen in private equity.
The boom that happened in venture during the period that capital was free in 2020 and 2021 felt very similar to me as the boom of excessive leverage in 05, 06, 07, in that you had investors that were increasing allocations to an asset class, which were allowing firms and funds to scale to meaningful size, to a level of scale that we had never seen before. And a lot of value that was captured within the asset class in terms of TVPI or total value sitting on investors' balance sheets that helped, like great returns on paper that fueled new commitments, but that was stuck within a fund, right? If you are an endowment, you had incredible returns coming from your venture pool. But if you actually looked inside of that, a lot of that was paper returns and had yet to be returned back to investors. So everyone felt great about your venture and growth commitments and supporting your investors or supporting your GPs because they had performed so well for you. But eventually investors tap out. And eventually people start to question what happens to the track record of a fund that gets very large. And I knew that either capital was going to remain free and we were going to have a problem because we were just going to start scaling beyond how venture was historically defined, or interest rates were going to rise. There's going to be some downturn in the markets, and investors were going to be totally overallocated to the asset class. And there was going to be a reckoning of firms to say, should you be as big as you are? Does it make sense to have mega venture funds? Should this be a cottage industry? All of this is just pure pattern recognition. If you apply what happened in 05, 06, 07, it is identical to what happened to venture.
So what you're describing is running towards private equity right before it collapses, and then running towards venture right before it collapses. So that seems different from the kind of opportunity you want to pursue. So
I'm a glutton for punishment.
Why don't you take me to the other side of that as why does that create an opportunity that you were excited about?
Great question. You can ask Brad. One of the first times I met Brad, he had just raised a $1.6 billion fund, which was 3 times the size of any previous pool of capital he had raised. We are in late 2021, not like maybe the market's starting to wobble, but really not. And I told him, your next fund, you should expect that half of the capital will come back from your existing investor base. And he looked at me like I was crazy. And he said, why do you say that? And I walked him through my thesis. And I think that made him want to hire me because I was a truth teller, first of all. And Brad likes a truth teller. But I think he could understand the risks to the business that nobody else was really talking about. I think the value in my role and why that opportunity attracts me is because I become more valuable. Capital formation becomes more valuable in a world where returns you get by just on returns. If you can get by just on returns and returns go up and to the right forever, you don't need me. You're never going to value me. You're going to think I'm administrative, that I just accept the checks. But where I become valuable is in knowing how real relationships are built, how to build a sustainable firm, how to weather storms, ups and downs. It didn't scare me that venture was going to go through a down cycle because cycles happen. I've been through so many of them. Things come back and technology isn't going anywhere. And there's technology is going to lead us into the future, and venture has been will be around, and new models will present themselves for how to invest in technology opportunities. That's what happened. Maybe my move to TPG was somewhat naive, and I didn't see that then, but that is actually what I learned, that when you get through the other side of it, you've created stronger relationships, you have new opportunities, you're more creative, and you can scale in a sustainable way. And that is fun and exciting.
How did you think personally about you could be having this conversation with Brad and hang out for a couple of years at TPG, go through the IPO, and then come in after the crash, as opposed to jumping in when you thought it might happen, knowing there's pain to come?
I could have just stayed on the sidelines and waited, but I knew that my skill set was needed and that I would have fun getting my hands dirty. Turns out I joined Brad. The first week on the job, our largest position in both our public fund and in our venture funds that we had distributed some, but far from all, was down 30%. My first week on the job. Brad looked at me at the end of the week and said, Are you okay? Are you going to stick around? And I said, I think this might be divine intervention. I'm here for a reason. I know what to do. And we linked arms, and here we are.
I'd love to chat with you about the types of conversations that you had, both with prospects and existing investors in your time with Brad. So let's start with the former. When you're thinking about raising capital, we talked a little bit about what that's like in the tough times, but let's just say you get through that. How do you go about the process?
So let's start with existing investors. There is a framework of communication that I think about as it relates to your existing investors and the communities of people that you're interacting with. Your most important, the communities that are most critical to your business. Okay, I put those in 3 categories. They would be your investors, your employees, and then the companies that you're invested with. We level set the communication patterns of the organization to make sure that our messaging is consistent and clear and concise across those 3 sets of constituents. And I think that's really important. And I think it's something that sometimes people take for granted. Let me give you an example. You could have change in your organization. Someone's going to leave. Your investors need to know that. Your employees need to be on message. And the portfolio companies that person may have worked with need to understand. If you're communicating different things to different people or communicating those things on a different time frame, you have a problem. Because if your investors are hearing something from someone else in the network that you haven't told them, it's a problem. And likewise, how hurt are your employees if they're finding out something that you've already been talking to about externally? So I think about our investor communications and make sure that we've level set of all the key messages that we're sharing with each constituent is consistent and clear and timely, and that we've made sure we've gotten that framework out. The second piece of it is just, do people really understand what really matters? Are you communicating to your existing investors what really matters? Your plans for the organization over the long term. In the existing portfolio, where are the problem children? Do they have a clear understanding of that? And where is the promise in the future? Where is the return going to come from going forward? If people have a good handle on that, then they will continue to support you with more clarity and more conviction. If there's any gray area around that, the plans for the organization, are you going to try to expand into new businesses? Are you going to fire your team? Are you going to make changes? Are you going to hire? Or if they're not clear on what's going on in the portfolio, then you're going to have a lot of trouble raising new capital from them.
You have different conversations with different LPs at different times. How do you calibrate to make sure that those messages you want to deliver are consistent and heard by everyone?
You have to use a lot of different channels of communication because we're a very small team and we can't get to everyone in a timely way. You can't control what different people in the organization are saying. And so you have to be flexible in the way that you communicate. We moved from we had an annual report that was not particularly powerful and maybe was hiding some of the good news and maybe some of the bad news if you deep into the reporting. One of my pieces of advice to GPs and people in my role is always don't assume your investors are reading the annual report. They're most likely not. And you can't get to, you have your key investors that you're going to get to first, but like, how are you going to reach everybody else? So I'd say have your list of decision makers and have your bullet points that you get out to people, at the most critical people at every organization. Have a concise communication that you share broadly with your team. Leverage the investors on your team to help communicate some of those messages. It's, for Brad, sometimes it's he talks about what's going on and in his worldview publicly. He might do it on CNBC. He might do it on other platforms. But connecting all those dots and not being rigid on we have to wait for a quarterly or annual report to get that out or wait for me to call everyone is what's critical. Use the different channels to get things out more timely, more consistently, more actively.
How do you think about communicating bad news?
I think about this a lot because so many bad things happen in the business. I reflected a few months back on all of the great things that have happened, the wins that I've been able to celebrate with LPs, and the bad things that I've had to communicate. And the bad things outweigh the good by 5 times. And I've worked for amazing investment organizations. It's just that shit happens. Markets turn, there's fraud in a portfolio company, someone leaves, you're going to mark down a business just because it's the right thing to do. All of this stuff, it's just the nature of the business. Great exits come around not that often. And when they do, you celebrate the heck out of it. Bad news, different thing. I have a very specific framework for bad news. You get out quickly and you address very clearly what I call PIE or PI, which is what is the problem that you're dealing with? Person, company, market change, interest rates, you name it. That's the P. What's the problem? What is the impact of that change? There's fraud in a portfolio company. The impact is that company is going to zero, or there's litigation, or you name it. That's the I. What's the impact? And then E, what is the investor's exposure? What can I expect to happen to my fund as a result of this problem? And that is simply putting into people's hands an answer to the question that they are inevitably going to get to the constituents that they report to.
You mentioned celebrating wins. What's an appropriate way to go about celebrating wins in the portfolio or in the business?
I'm a big fan of celebrating with abandon. I actually see people under-celebrate all the time because for some reason you have people that aren't like, and this is, I'm going to make a sweeping generalization that, investment management isn't awash with humility. But all of a sudden people have a big win and they say, yeah, this was a really good one for us in a way that feels super humble. And I say, if it was amazing, say it was amazing. If this was a historic win, make sure that is clear to your investors. If this is an unprecedented outcome for an industry, say it. Your investors, don't expect them to read through the tea leaves of your humility. Shout it from the rooftops. This goes back to the fact that this goes back to the constituent question. Those investors have their own underlying constituents. And Nothing feels better than looking good to your boss, and you want to arm your investors with the data points that make them look great to their boss. And so nothing feels better than you should be able to say to a state pension, we just had an incredible victory in our fund by, a company getting acquired for a 25x, and this is going to return our entire fund in distributions back to you over the course of the next year. And we feel very proud about that. And we're proud that you're our partner. That is something they can take and deliver with pride, which feels really good.
I'm curious how you think about adding value to your partners beyond just the knowledge and the performance you're delivering. Quite different, I would imagine, sitting at Altimeter doing one strategy than at a TPG or Goldman, where there's just lots of different inputs and strategies that people may be interested in.
I actually think the framework of adding value is not different between organizations. We make a point at Altimeter of asking investors when we're meeting them for the first time, what does a great partnership mean to you? If you think of the most important partners to you in your book of investors or your line items of investments, what are the qualities of those partners? Returns are never the first thing that they list. Communication, trust, sharing of insights, sometimes deal flow are almost always the consistent answers that we receive from the largest to the smallest organizations. There's something to learn by that, which is if you're in the business, returns are table stakes, and this is all about what else you deliver to people. And a lot of that comes down to just great communication. So when I think about what that means at a Goldman Sachs, when you have tons of resources to Altimeter, which is a very small organization, to me, it's bringing what are the most unique insights that are available to me that I can bring to the investors that I work with. That might be Brad's view on large language models, or it might be a soundbite from a Goldman Sachs economist, but the characteristic is the same, which is it is unique and it can be communicated back in a timely way to add value to our investors' portfolio or to help them understand what we do and the value that we bring in a more cohesive way.
I'd love to turn to prospecting for new clients and how you think about that process.
The land war that we fight in going around the globe and building new relationships, especially in a world where capital doesn't necessarily flow free these days. It's not always easy. I think what I have learned is the most important way to build your brand is the great existing relationships that you have. I've asked many LPs how they source new relationships. The number one answer that I get is from other LPs. So to me, that says your existing relationships are the key to building new relationships. Having a warm referral, having a great institutional investor when asked, say, who are some of the best partners in your book, or who's doing something really unique, or who's your best partner in tech, say your name, is a great way to build relationships. I think that's number one. 2, having an understood brand in the market, telling your story when you're not marketing. That could be by being present at industry events. It could be being on CNBC. It could be simply having a presence in places where LPs exist. But it's always wonderful to sell yourself when you're not actually fundraising. The capital should be raised before you're even in the market, is something that I like to say. So I think many people think about prospecting that I'm going to go raise a fund and now I'm going to build these relationships so that they commit to my fund now. That's not the right way to building relationships. Building relationships is a longer process that comes over brand building and building presence and relationships over a much, in a different time frame.
How have you gone about establishing the relationships over time with people that aren't investors, recognizing they have their own set of relationships and they're very, very busy?
One of the things that I do is think about that same value add that you are providing to your existing investors. How do you illustrate that to someone before they're an investor? So that unique subject matter expertise that you may have as an organization, start to prove the relevance to an LP before they're an investor so that they know what the investor experience may look like. Some LPs will say, we'd love to do a deal with you, do a co-investment with you before we invest so we can see how your organization works. That's really hard because you have a lot of mouths to feed from your existing investor base that want your co-investment. So I actually would say that's a very hard ask to deliver on in practice. But what they're really trying to say is, I want to understand what you can uniquely bring to me that I'm not getting from other places, and I want to understand how your organization works. For me, that is reaching out to people that I've met that are important, that I want to build a relationship when something happens in the market like DeepSeek and we have a view, and I share our view with them. Sometimes it's inviting them to a webinar we're having with our existing investors where we're going to talk about something topical that may be of interest. They can see what types of content we deliver to our investors. Unfortunately, it's rarely a deal because we have plenty of people that want the deals. But it is around that transparency and unique insights piece.
When it comes to communicating what it is you do, right, and part of showing that as part of it, what have you found most effective in telling the story?
First of all, people love deal stories. They love storytelling. If I reflect on the most impactful fundraisers and marketers that I have worked with, they are incredible storytellers. They bring you inside what's happening in a deal. Hearing David Bonderman tell the story of how they bought MEMC for $1 in 1999 is so incredible and unique and insightful, but also just fascinating. So it's not just about talking about I'm doing this deal or we are involved in this market. It is about bringing that to life and getting the people on the other side of the table engaged and excited about what you're working on. I think Brad is uniquely talented. I think it's no surprise that he built his early career as an attorney, and in politics, he knows how to tell a story. And when he talks about the future of AI, you feel something. You have to have the investors on the other side of the table feel something. That is what makes someone inclined to action and biased to action. I think they also need to connect with you personally. I think that we're beyond transactional at this point. If someone's going to especially institutional investors, they're going to put capital behind you. They're going to use their very slim allocation to make a new investment that involves 10 years of relationship and trust and a ride through markets and illiquidity. They really have to have a sense of who you are as a person and reveal, and your personality is going to help reveal differentiation. There's also another framework that I think that is important in building new relationships around what every manager, you need differentiation at every turn. And I think of it as literally a circle with 5 components, which is sourcing. How do you source your ideas? How are you coming up with your ideas? How do you pick those ideas? Sourcing, picking, winning, adding value in whatever market you're in, not to your investors, but to your companies. And then how do you think about exiting? If you've left the room and you haven't covered those 5 things, you've left them wondering about your strategy or how you really are managing your portfolio.
When you think about that personal relationship side, how do you think about the impact of someone in your seat and your relationship with the LP as adjacent to or compared to Brad's seat and his relationship with the LP as the person who's managing the capital?
I think of myself as a really important liaison. I never think of myself as a substitute for Brad in the room. I never will be, but I'm a really important conduit that plays a critical role. One, they need to trust that I'm going to deliver important, relevant information and all the things they need to know. I'm going to make sure they get it. 2, I am transparent and trustworthy. A sounding board for when there's issues going on that they within our fund or in our portfolio, or they have concerns that they can come to me and that I will accept all feedback in a safe place. Sometimes it's hard for people to tell Brad that they're upset with something that we've done, or they don't like an investment, or they're concerned about changes that we're making on a team. I know I'm winning when an LP is telling me what they're not happy with. If they're just telling me they're happy, I actually keep digging. Because to me, the way that I can add value is the feedback loop from our customers, our key partners, to Brad, and not so that he changes the way that he may act or changes the deals that he's doing, but that he's conscious of how the market is perceiving that, because ultimately it will impact how we're able to raise capital going forward. When those feedback loops are broken, it's problematic for an organization. I love it when people turn it back to me and say, your most valued partners, what do they do for you? And I say, they tell us the truth. They tell us what they're thinking.
What are some of the most common mistakes that you see GPs make when they're in the market to try to raise capital?
The biggest mistake that I see GPs make is they say too much and they don't listen. If a GP meets with a new investor or even an existing investor and they're raising capital and they have talked through the whole meeting, it's a missed opportunity and it's a problem. You have an opportunity to interact with your customer, partner, and understand how they think, understand what's important to them, understand how the organization works, understand their process. You should take advantage of that. And know your customer deeply. You should be making decisions about who the right capital is for you. It's not about just them deciding that you're the right partner. What is the right capital base for your firm, for your strategy, for the next 20 years of your organization? It doesn't all look the same. Not all investors are created equal. And you want to make sure that you're getting partners and customers that are aligned with the goals of the organization that they're going to invest with you over the long term. So that's the number one mistake that I see people make.
I'm curious about the difference that you've seen in, say, public funds or in the hedge fund side of Altimeter. And a lot of what you described in terms of building the relationships when you're not raising capital is that private fund cadence. So how does that change, say you're giving advice to someone who's managing a hedge fund or a public equity fund where effectively they're always in the market?
Public fundraising is so hard. I am so lucky that I built my career for basically, 20 years with only having to, raise capital, and then it basically sits there and you don't have to fight the redemption and you get a break between fundraisers and their cycles. I have deep appreciation for people that are doing an open-ended fund construct and the constantly in the market construct. At the heart of it, I don't think it's different. I think it's about building relationships before you make the ask. Though you may be in the market, it's about taking time and understanding that there's a sales cycle before you just march in and ask for the check. So though you may be open, don't treat it as such when you're building a new relationship.
Now, Meghan, I know that you've had a very fun Twitter X account summarizing some of the conversations that you have with LPs over time. And I'd love to just get your opinion on some of the things in the market now. So let's start with fund flows. Been a tough time. What are you hearing from LPs about what their plans are in the private markets?
It has been a tough time. My reflection is that it is the hardest time, and it has, for the last 3 years, it's been the hardest time to raise capital in the 5 years that I've been doing this. And that includes 2008 and 2009. It's actually hard. It's been harder. Why? Because in 2008 and 2009, you actually had people that were still in building mode, that didn't have big allocations to alternative investments. They were blank slates, and they knew that this was a good time to invest. So though very little actually closed during that time, a lot of new relationships were still building, a lot of planning was still going on, and there was capital raising going on behind the scenes, and capital raising for recovery capital and tactical funds. The last few years, there's very few blank slates. There's very few people that are taking their allocation from 5 to 10 to alternative investments, or from 10 to 20. If anything, they are grossly over-allocated because of the lack of exits, and that is consistent across almost every channel of investors, from endowments and foundations to family offices. There's very few exceptions. One of them is the retail channel, which we can talk about. My observation from feedback from LPs is this is about haves and have-nots. This is a market of, am I backing someone that actually deserves to be here, that wasn't just a fluke fund that was able to get raised when money was free, but someone or an investment organization that's really going to be positioned to grow for the foreseeable future. I do think that's why there's been safety in larger funds, because there's a sustainability to that capital and those organizations versus smaller organizations that don't have the track record, don't have the history of distributions, DPI, that other firms have experienced. And the result of that is going to be all of this is going to be very scary if you were an emerging manager during 2020 and 21. And I define an emerging manager as someone that raised their fund 1 or fund 2 during that time.
So if you bring together, you mentioned the retail channel and the strength of large funds, there's a lot of capital coming into the space at private markets, defined broadly into that. What do you think happens with return expectations?
So I think that there's going to be a bifurcation of return expectations for mega funds versus smaller funds around, and I'm specifically speaking about venture now, because that's generally in the private markets, that's generally the world where I'm operating. By the way, and I'm saying that because this is exactly what happened in buyout. Here we are again with the pattern recognition. You had buyout funds, pre-mega funds that were consistently delivering 3x plus returns before they got really large. They got really large, and then they consistently returned 2x. I just was looking at KKR's returns, which were in a Bloomberg article just this morning. And sure enough, their pre-80s, pre-billion-dollar funds all returned 3x plus. And then after 1987, they raised a series of many billion-dollar funds that have consistently returned somewhere around 2x. My theory is that the same bifurcation is going to happen with mega funds versus smaller funds that are able to, in venture, take advantage of power law and drive bigger returns. 2x and participating in that part of the market with a brand that you know and love may be sufficient for certain pools of capital. I think that you will see the institutional investors that have historically loved venture and participated in those big pools move down market, just like they did in buyout. All the ENFs left the mega funds in between 2008 and 2012 for the most part. I think the same thing will happen, but you saw retail move in. You saw, the iCapitals of the world, like Blackstone selling massively at JP Morgan, like KKR, all those wealth channels started, like all of those mega funds started selling in the wealth channel. I think the same thing will happen. And I think that there's plenty of people in retail and high net worth that have no exposure to the asset class that will be very happy to get exposure to great firms like General Catalyst, these mega funds that allow them to participate in a market that they hadn't participated in before.
If that leaves a very large swath of smaller funds, some of whom have brands and pedigrees and have succeeded, and many of whom may not, what happens with the challenges in fundraising throughout the rest of the venture market?
I should draw a distinction around big funds and large funds, by the way. I'm specifically talking about classic venture when I'm referring to that. I actually think there's this emerging understood part of the market, which is scale, which is growth, that is getting redefined at the moment, that does scale because of the size, like companies staying private for longer, because of the scale capital raising that's being done with those companies where you can deploy at scale. And by the way, I think that's a different return profile. I think that's more of a 2 to 2.5x and an IRR strategy that's similar to what you would expect in public markets. These are quasi-public scale private companies. But your question was around what happens on the venture side and to some of these, the smaller organizations and the constrained capital raising. I think a lot of the funds go away. I think a lot of funds cease to exist. I think that there's thousands of zombie funds in the market that will never raise another fund because their track record does not justify it. And because people will realize that venture is not a get-rich-quick scheme, that not everyone and their mother deserves to have a venture fund. I think that all goes away. I think that it becomes like the brands that deserve to be there and the differentiated products and models move forward. And I think fundraising looks a lot like what it did historically, which was there was a pretty steady pattern around venture fundraising that was going on in 2015 and 2016, 17, 18, even 19. And then it went crazy. And I think I think we're just back. And I think we're just going to tick along trudge along like we were trudging along before in a healthy way.
So for those smaller firms that you could look and ostensibly have a right to play, they've generated strong results, but are still struggling in that fundraising aspect of their business. What advice do you give your friends who reach out and say, how do I do this? How do I grow?
I say throw your 2021 fund size out the window. A lot of calls I get are from GPs of funds that are on Fund 2 trying to raise Fund 3 or Fund 3 trying to raise Fund 4. Their last fund was raised in 2021 and it was, name a dollar amount, $400 million or $200 million. But their previous fund was 50 or 100. And now they've raised 50 or 100 and they don't know what to do. And I say, congratulations, that's amazing. Just invest it, keep going, readjust. Just swallow the pill and go back to where you were before, reestablish yourself and grow from there. The market is giving you what you deserve. And it's saying that moment in time was an anomaly and that they want to see more from you. And hopefully you run the business that you can live off of those management fees. And I think it's a very healthy gut check to say if you can't, then you need to make changes to your organization, or maybe you shouldn't, or if that's not enough money for you, you should do something else. And that's okay. And by the way, in 2005, 6, 7, 8, funds contracted by 50% when they went to raise their next fund. That happens. And it's a pride swallowing siege, as I like to say, but that's a line from Jerry Maguire. But that's just what you need to do to move on.
Would love your view on LPACs.
I love LPACs. They're the best.
And
Full
what do you
stop.
really think?
No, I actually do. I actually think that sometimes there's a perception that an LPAC is this just, a administrative burden to an organization, that this is a body that you have to, creates an extra burden of regulatory, of reporting or some regulatory burden on your organization. And I think that is short-sighted. I think that generally LPACs represent the largest and most strategic investors that are a part of your partnership. And I think that consulting them on some basis on matters that are important, that are tricky, that are may be consequential to the business is really healthy and important. If you have something going on in your organization, you want your largest investors on Seides and fully understanding that, because most likely you want them back into your capital. And so when you have a body that can give you feedback and be those truth tellers for you and feel comfortable about what's happening, whether it's a conflict of interest or whether it's because you're going to raise a new strategy and they have approval rights or whatever it is, embrace it and recognize that this is your opportunity to get your most important investors feedback and get them on Seides. Because of that, and because they often do have rights that could be consequential to the business, be very careful about who you put on an LPAC. Be very thoughtful about it. Make sure that you don't just give away the rights, but that you really have a group of investors that will listen and tell you the truth and be rational and understand the organization and governance structure that sits behind them when you're making those decisions. Often I see people have situations where they've put people on their LPAC from an organization. That person leaves, you get someone else, and that might not be the champion that you had before. That's challenging. So make sure you take that into account when you're building your LPAC.
What are some of your other favorite concepts and things you've heard that you've been writing about?
I really am interested right now in fund math around venture to understand the dynamics around venture capital as an industry, because it is a power law business, how that translates to how you should size your fund and how you should construct a portfolio to optimize returns. It is very different because of the power law dynamic in venture that only a few deals drive the returns for the whole industry than buyout portfolio construction or growth portfolio construction. You have to weight your capital differently. You have to size your funds differently. And in the world where so many people just went out and raised venture funds and everything was working, and for a minute there, it wasn't a power law industry, everything was delivering great returns, you could get away without having to be thoughtful about that. But if you actually look at the historical data, it's very hard to achieve. There's been very few funds that have achieved in history 3x plus that were over $1 billion. And when you dig into the why, it is because you have to size and weight your capital to deals accordingly to maximize those returns. And it's hard to do that at early stages. So I'm very fascinated by this because I think understanding it will make and having agreement on it across the whole ecosystem between LPs and GPs will make us all more powerful. It will help LPs understand what to do with a track record that's concentrated around one deal. Do they celebrate it, or is that a complexity that you need to wrestle with? It will help GPs think about how to manage reserves, how to think about opportunity funds, how to size capital. That's one little course of study that I've been undertaking. I have follow-ups to tweets that I'm keeping in my keeping in my back pocket for a Saturday or Sunday when I'm ready to get more intellectual. Sometimes I just quote people.
Any other favorites?
I definitely am unpacking this, what's the difference between growth and venture, growth at scale versus venture? How do we define the strategy or the asset class? What it means, like quasi-public businesses that for companies staying private for longer, like what do we do with that as an investment realm, right? That we've never really dealt with that at scale before, although like obviously the trend has been there, the existence of companies like Databricks and Stripe and even OpenAI, which is so large scale at this point, like those are truly quasi-public. So what does that mean from a return perspective? Where does it fit within a portfolio? Should it actually be getting allocation from the more public side of the book? Like I love, investors are talking about this right now. So I'm excited to explore that. One more thing that I'm exploring is co-investment. I had a tweet this past week that got a lot of spicy responses. I think I might have struck a chord, and it came from a conversation I was having with an LP. Usually my heard from LPs this week always comes from a topic that I happen to be discussing that I think might be interesting to the world that we live in. The tweet basically said that you have these very few organizations that we work, very few institutional investors or organizations are actively managing public equity portfolios. They're not choosing stocks directly, but almost all of them are choosing in private companies directly and co-investing in companies where they have less information, that are less liquid, where there's more risk. So as an organization, if you are not comfortable investing in public companies directly, what makes you sufficiently resourced to invest in private companies directly?
Very fair question.
Just a question.
I don't know. Yeah. All right, Meghan, I want to make sure I get a chance to ask you a couple of closing questions. What is your favorite hobby or activity outside of work and family?
I love spending time outside in nature. California is a glorious place to live, to be able to do that. I also grew up at the beach. I grew up at the Jersey Shore and love staring out into the abyss of the ocean and recentering myself. Lately, it's been an obsession with redwood trees and getting lost in a forest with my kids. It's very grounding for me.
What was your first paid job?
Well, I grew up in a family that believed that if it wasn't something you needed or you were getting for your birthday or for maybe a holiday like Christmas and you wanted it, you needed to get it yourself. You needed to pay for it yourself. So technically my first paid job was scrubbing kitchen floors and bathrooms and doing chores at the age of 6 or 7, true story, for my mom for an allowance so I could buy my own clothes. But my first paid job was working for Hoffman's Ice Cream in Point Pleasant, New Jersey, a family-owned little old-fashioned ice cream parlor. I applied for the job the day that I turned 14, which is when you could legally work in New Jersey, and I absolutely loved the job.
What did you love about it?
Delivering ice cream to people and bringing them joy is like, what's better than that? I love making people happy. That's my Enneagram 9 coming out. Like, what's better than pleasing someone and giving them and it was a really great quality product. It was handmade ice cream. We were hand making these ice cream cakes. Everybody in town got their birthday cake from this store. It was just like commitment to quality with so much joy and love put into it.
How's your life turned out differently from how you expected it to?
I never expected to have traveled the places that I've traveled, to have met the people that I've had the pleasure of meeting, and in like these really fascinating places and fascinating parts of the market. Like being able to do what I do was beyond the wildest dreams of a little girl that worked was the child of two elementary school teachers in a hamlet. I think you could literally call the town that I grew up in a hamlet by the beach. And I feel so incredibly blessed and lucky to be living the life I'm living. The other piece of it is you have these expectations that you're going to have children one day and they are going to be chips off the old block. And my children are nothing like me. And so that's not what I expected. And that, I think, is probably an experience of most parents, that you just throw your expectations out the window when the kids arrive.
Safe to say. What's a mystery that you wonder about?
I wonder about what happens when we die. I wonder about how the life that we lead, like the implications of that for whatever happens next. And I try to be I live my life knowing that that is a mystery at the end of the day. And so take that into account.
All right, Meghan, last one. If the next 5 years are a chapter in your life, what's that chapter about?
That next chapter, I think, is primarily about three things. The first is being a mom to teenagers, which is my daughter just turned 13. It's the next 5 years. This is it. This is before they go off to college. I gotta make this chapter really good. And I know having teenagers is going to be a book that I have no idea how to write. So we'll figure that out as we go. The next 5 chapters professionally are about the age of AI and the impact to our business. That is investment opportunities. That's how we interact with the world. That's how we interact with people. Everything's going to change sooner than later. And we're gonna figure that out on the fly, just like being a mom to teenagers. You figure that out as you go. And then I think the third thing would be, it's a chapter where it's more about me sharing what I've learned and reflecting on my first 2 decades as I'm in my third, and thinking more about pattern recognition and passing that on to the teams that I work with, the organization that I'm a part of. I'm more reflective in my mid-40s than certainly in my previous chapters.
Well, Meghan, thanks so much for sharing all of your insights from the past few decades, and good luck with the next few.
Thank you for being interested in chatting through it.